Hi. Welcome back to Cheryl Trades, Leaps. Everyone says the same thing when you start investing. Diversify your portfolio, spread it out, reduce your risk. And they're not wrong. But here's what they leave out. Diversification protects your money. It does not grow it. And if you never learn the difference between the two, you'll spend years doing everything right and still wonder why your account isn't moving. So today, we're breaking down both strategies, what they're actually for, and how to use them together. 1. The misunderstanding that costs people money. The reason most traders struggle with this is simple. They treat diversification like a universal rule, like it applies to every situation, every account, every goal. It doesn't. Diversification and concentration are tools, and like any tool, using the wrong one at the wrong time doesn't just slow you down. It can actually work against you. Use too much diversification when you should be pressing an advantage, and your gains get watered down to almost nothing. Use too much concentration when you should be protecting capital, and one bad trade can set you back months. The question is never which one is better. The question is always, which one does this moment call for? 2. What diversification is actually for. Diversification has one primary job: protecting your capital. When you spread your money across multiple stocks, different sectors, or broad index funds like QQQ or the S&P 500, you're making sure that no single position can seriously hurt you. One company blows up, you barely feel it. One sector has a rough quarter, your portfolio keeps moving. That's exactly why diversification works so well for long-term investors, retirement accounts, and passive strategies. It smooths out the volatility. It keeps you in the game during rough patches, and over time, it lets the market do the heavy lifting for you. But here's the trade-off most people don't talk about. When you're diversified across 15 or 20 positions, and one of those stocks goes on an absolute run, it barely moves your overall portfolio. That win is real, but it's diluted. Diversification limits your downside, and it limits your upside right along with it. 3. What concentration actually does. Concentration is where real growth happens. Instead of spreading capital thin across positions you half believe in, you put meaningful money into your 3 to 5 best ideas. The setups with the clearest trend, the strongest fundamentals, the highest conviction. When you're right in a concentrated position, your capital is actually working for you, not sitting in 10 other stocks waiting to maybe do something. This is especially powerful for swing trading, leaps options, and momentum plays. These are strategies built around identifying a specific opportunity and capitalizing on it. Spreading that capital across 15 different ideas defeats the whole purpose. But concentration has a real cost too. Your volatility goes up, your drawdowns go deeper, and the emotional pressure of watching a concentrated position move against you is a completely different experience than watching a diversified portfolio dip 2%. Your drawdowns go deeper. And the emotional pressure of watching a concentrated position move against you is a completely different experience than watching a diversified portfolio dip 2%. Without discipline, concentration can destroy an account just as fast as it can build one. 4. The framework that actually works. So, what's the move? Not full diversification, not extreme concentration. The approach that actually works is what I call focused diversification. Instead of holding one stock with everything riding on it, or spreading so thin across 20 positions that nothing matters, you hold 3 to 5 high-conviction positions, each one aligned with a strong theme, a clear trend, and a setup you genuinely believe in. In today's market, that might look like a position in AI infrastructure, one in cloud platforms, and one in semiconductor leaders. You're diversified enough to absorb a hit if one of them turns. but concentrated enough that when they move, you actually feel it. That's the balance. Diversified enough to protect you. Concentrated enough to grow you. 5. What most traders get wrong. Most traders fall into one of two traps. They over-diversify out of fear. They spread their capital so thin that even a great call barely moves the needle, and they wonder why their account looks the same every month. Or they over-concentrate out of greed. They go all in on one idea, it doesn't work, and they take a loss that takes months to recover from. Both are emotional decisions, and both lead to the same result: frustration. The real edge isn't in picking the right strategy. It's in knowing when to protect capital and when to press your advantage. That's the discipline that separates the traders who build accounts from the ones who stay stuck. Final takeaway. If you take one thing from this video, make it this: diversification protects your capital. Concentration builds your wealth. And the goal isn't to pick one and ignore the other. The goal is to know which one the moment calls for and have the discipline to use it. If this was helpful, subscribe for more content on leap strategy, market structure, and how smart money actually trades. I'll see you in the next video.